Hey, Dan Passarelli here. Happy Friday. Woohoo! We made it. Another one down in the books. Now, I wanted to talk today about something to think about this weekend. Something that some traders have been chattering a little bit about recently as to what it might mean, and that is the potential longshoremen strike that they're talking about. Now, they've been labor and the companies there have been butting heads since June, as I understand it, even before then. And their contract expires September 30th. And the union said that they are ready to strike if as soon as their contract ends on September 30th, if their demands are not met. So, what does this really mean? Is it a big deal, a little deal? What does it mean to the economy? What does it mean to your trading? Okay, so first of all, hey, there's still 10 days. Fingers crossed, maybe they can reach a deal. If not, it depends how long the strike goes. If it's a short one, it's probably not going to be a big deal at all. If it's a long one, it could potentially be a really big deal for a couple of reasons. Think of this whole inflationary period that we just had. What is one of the things that led to the high inflation? Well, one of those things was the port shutting down as a result of the COVID restrictions that were in place, where people couldn't go to work at the ports and stuff got backed up there, and that messed up the whole supply chain. And that caused inflation because people had to pay more because they couldn't get things. And if they could get the things, they'd pay through the nose for them, and that's just inflationary. All right. Now, if the longshoremen do strike, I have read that it can take 4 to 6 days for every 1 day that the port is shut down to get back online. It's a short period of time. I don't know. It's not ideal, but it'll work out. Long period of time can cause some really big problems. Now, there's been an increase in imports, about 10% higher than last year on the East Coast and 20% higher on the West Coast. And a lot of that, I think, had to do with importers anticipating some of this and getting some of the Christmas merchandise all locked down and in the warehouses right now before the strike happens. So there's probably some planning that already took place, which will provide a buffer if it's a short period of time. Now, if it's a longer period of time, we could see a rise in inflation because the supply chains can get all gummed up. And, well, I just told that story of how it went last time with COVID. Now, if we start seeing inflation come back right when the Fed is just about getting it closer and closer and closer to its mandated 2%, if it starts ticking back up, we're not going to see interest rate cuts. And if we don't see interest rate cuts, or if the market believes that we're not going to see interest rate cuts, or at least not ones as big as they think, which is 50 basis points, although the market's pricing in even more than what the Fed said that they're likely to do, that's when the market can sell off. So we've got a little bit of time before we have to worry about that, but we always like to get these things in the backs of our mind. The next 10 days, obviously, it's nothing. If a strike does occur, we've got to start thinking about that. And we've got to start watching, and we've got to start looking at volatility. The VIX and such will likely go higher, and the market will start going lower if it looks like the strike is going to affect supply chains enough to lead to higher inflation. So there's some food for thought looking ahead at this event. And hey, I hope that helps. This is Dan Passarelli, Trade Smart.